Hi everyone, very good morning and welcome back to Crack Grade B. So today in this particular lecture we'll be discussing about the accounting ratios, okay? And regarding the playlist, see in our playlist section there is already a playlist created by the name of EPFO, right? There's a playlist by the name of EPFO, and in that particular playlist the first video I guess is of set theory, which is there for your QA section. So that is why it is a bit confusing, but when you open that particular playlist there are around some 16 videos already uploaded in that particular playlist, so it will be accessible to you. Okay? Just see the playlist by the name of EPFO in our playlist section. Now let's start with the lecture today. So half of the ratios I'll be covering today, right? And half of the ratios I'll be covering tomorrow. So I have divided it like that. First of all, in the accounting ratios related section, obviously we are going to study ratio. But before that, some advantages as well as objectives also I have included. Now the question might arise that why you have included objectives and advantages when we are aware about them. So the answer to that is, sometimes in examinations, even in your EPFO examination, you can expect that the statement wise questions can appear, right? That what is the objective of ratio out of these following statements. So if you will be very clear about the objectives as well as the importance of ratios, it will be easier for you to answer. Number one point, right? Why obviously someone will say that these kind of knowledge is available to us when we will read the answers, but no, sometimes technical wordings are used, right? So it is better enough that if you already understand the objectives as well as the benefits in theoretical terms. So with that, let's start. Now, why the accounting ratios are important as a topic for us. So, for example, suppose if I say you that there is a company ABC Limited, right? And in the current year, it has earned a profit of 1 crore. I said that there is a company ABC Limited and in the current year, it had earned a net profit of 1 crore. So, one might say that, okay, nice, great. Now, but when I can use this particular information more meaningfully is when I'll say you that, okay, ABC Limited in the current year, it has made a net profit of 20%. So this information becomes more useful for me, right? Because why? I am comparing net profit also. I am getting to know about sales as well, and I can compare this 20% with any other entity. Suppose XYZ Limited. XYZ Limited might be earning a 10 crore profit, right? This company is earning 1 crore profit and this company is earning 10 crore profit. But its net profit ratio is just 10%. So can you tell me, if you were an investor, in which company you would like to invest? XYZ Limited or ABC Limited? If you were an investor, in which company you would like to invest? So see, in my case, in my opinion, although this company is right now very good. So right now this company is earning lesser amount of profit, but going forward it will earn a good amount because its net profit ratio is very good as compared to the XYZ Limited. So if this company is having growth potential, then I will definitely invest in this particular company. Okay? So this is the importance of ratio. If you see 10 crores and 1 crore, these are what? These are absolute figures. I do not have any specific information out of it. But when I compare the ratios, I get the more useful information. Okay? Let's see. So a ratio is a mathematical number which is calculated as a reference to relationship of two or more numbers, and it can be expressed as a fraction, proportion, percentage, as well as a number of times. When the number is calculated by referencing to the two accounting numbers. Two accounting numbers means, suppose I am comparing profit with the sales, right? So when I am comparing profit with sales, I am comparing two accounting numbers and it is termed as the accounting ratio. Clear? Easy? Now next thing is objectives of ratio analysis. What are the objectives that we have? See, it is a technique for regrouping of data. Financial statements you already make, right? You make profit and loss account statement, you make your balance sheet, but how to get the useful data out of it is the art that we practice in the accounting ratios. Now let's see the objective one by one. Number one is, it tells us that which area of the business needs more attention, right? So suppose I have calculated inventory turnover ratio. Inventory turnover ratio means how fast my inventory sells out or sold out. So in that particular case, if my inventory turnover ratio is not good, then this is a sign that I have to look into my marketing practices, right? I have to see my sales channels because they are not performing well. Number one thing. Next thing is, it also tells you the potential areas which should be improved with the effort in desired direction. Okay? So it tells, obviously it is combined with that particular point. Next, it gives you a deeper analysis of profitability, liquidity, solvency, as well as the efficiency level in the business. Like the example I used in the initial, two entities were there, one was earning 1 crore, the other was earning 10 crores. But still, when I calculated net profit ratio, we got to know that the entity which was earning 1 crore was the most profitable one, or investors would like to invest into that particular entity. Why? Because it is having a good net profit ratio, right? So with that particular thing, it gives you deeper analysis of your profitability, liquidity, as well as the solvency position. What are these individual terms? We will come to them one by one, right? Because there are sections allocated to them. Next is to provide information for making cross-sectional analysis by comparing the performance with the best industry standards. So next thing, I also compared the performance of ABC Limited with the XYZ Limited. So it is helpful for me in the comparison, whether I want to make the intra-firm comparison, that means if I want to make the comparison with my competitor, or if I want to make the comparison with the industry as a whole, it helps me in every way possible. Next, it provides information derived from financial statements, useful for making projections as well as the estimates for the future. Nice. Next are the advantages. See, number one advantage is it helps to ascertain that whether your decisions are adequate or not. So the ratio analysis helps you to understand whether business firm has taken right kind of operating, investing and financing decision. So the answer is, understand this. Suppose you are into the business of manufacturing of biscuits, right? Your gross profit ratio is 10%. This is your gross profit ratio. But your net profit ratio is 20%. What does it tell? If I tell you that there is an entity which is having a gross profit ratio 10% and a net profit ratio of 20%, what does it tell about the entity? Anyone? So it tells that the business of manufacturing of biscuits is not giving me enough profits. See, gross profit is the profit that you derive directly from your activity, operating activity, right? The business you are doing. In this particular case, having a lesser gross profit does tell me that my business is not doing well profitably, but my indirect incomes are good. My indirect incomes are good, and that is why my net profit is good. That means I have done great investing activities. Fine. I might have invested in shares, real estate, etc. And out of that I am earning profit. Correct? So it also helps you to understand that whether the operating, investing and financing decisions you have made are good or not. Now please be aware, such kind of statements can be picked up directly. Okay? So please be attentive of that. Next is simplifying the complex figure and establishing the relationships. So obviously, if the figures are written like this, correct? One figure is written like that, the other figure is written like that. Now these are absolute figures, right? As a layman, I do not understand them. I just want to know that what is your net profit, what is your current assets to current liabilities, right? I just want to know the ratios because I am not at all interested in your absolute figures. They might be useful for the shareholders, they might be useful for the directors and management, but they are not useful for me as an investor. So what I want is I want the ratios. Next thing, helpful in comparative analysis. We have already seen that. Identification of problem areas, we have already seen that. Now next very important thing is this. Can also be a statement question, that it enables SWOT analysis. SWOT analysis means strength, weaknesses, opportunities and threats, right? Out of this, strength and weaknesses, they are internal. Internal means there can be strengths in me and weakness in me. Correct? My internal strength and weaknesses. Opportunities and threats are those arise from the environment. Correct? So suppose how well I can study, that is my strength. Okay, I can study for longer number of hours, that is my strength. Now if there is a frequent power cut in my area, now that is a threat, because that has emanated from the external environment. I do not have any sort of control onto this. So this is called as a SWOT analysis. So ratios also helps a great deal in explaining the changes in the business. The information of change helps the management to understand the current threats and opportunities and allows the business to do its own SWOT analysis. So this is also a prime objective of calculating accounting ratios. Once we have completed the advantages, now you have to remember the basic things like ratios helps you in the intra-firm comparison. Ratio helps you in understanding whether the operating, investing and financing decisions made by you are good or not. Apart from that, it also enables you to do the SWOT analysis. Why I have included it? Because these things can be directly picked up by the the paper setter, that okay, tell that which of the following are the objectives of ratio analysis, right? So these are low hanging fruits and we should always be upping for them. Now next is classification of ratios. So ratios are classified in two ways. Number one is the traditional classification. Traditional classification means that ratios are classified on the basis of which from where they are using the data, right? So traditional classification means this is on the basis of financial statements. So there are some ratios which use the figures from the your profit and loss statement. There are ratios which only use the figures from balance sheet, right? And there are ratios which uses the figure from P&L account as well as from the balance sheet. So they are called as the composite ratios. So this is that particular classification. See, traditional classification, as per traditional classification, the ratios are classified on the basis of from which kind of financial statement they are using the data. So number one is statement of profit and loss ratios. A ratio of two variables from the statement of profit and loss is known as the profit and loss ratio. For example, gross profit ratio. Gross profit ratio mein we are using the gross profit. This is also from the profit and loss account, and I am using sales as a denominator. This is also from profit and loss account. So this will be called as statement of P&L ratio. Fine. After that, we have balance sheet ratios, right? So in case both the variables, means the two variables that you are using, if both of them are from balance sheet, then such ratios will be called as a balance sheet ratio. The example of this is like current assets to current liabilities, which is known as the current ratio. Okay? It is known as the current ratio. So current assets divided by current liabilities, both of them are picked up from the balance sheet and hence called as the balance sheet ratios. Next is the composite ratio. Composite ratio means when one figure is picked up from the P&L account and the another figure is picked up from the balance sheet account. For example, debtors turnover ratio, also known as the trade receivables turnover ratio. Debtors turnover ratio or trade receivables turnover ratio. How this particular debtors turnover ratio is calculated? So DTR, that is debtors turnover ratio, is equals to your credit sales divided by debtors. That means your average receivables. So see, debtors we have picked up from the balance sheet and credit sales we have picked up from the your profit and loss account. Now next, once we are done with the traditional classification, now the second type of classification is the functional classification. Okay? So under functional classification, we have classified the ratio into different types. Number one out of that is liquidity ratio. So liquidity ratio means what? To meet the commitments, business needs liquid funds, and the ability of the business to pay the amount due to stakeholders as and when it's due is known as the liquidity. Fine. They are short term in nature. So this, please remember this. Whenever you are calculating liquidity ratio, see, I know many of you already understand the concept of ratios, but here I have tried to focus on the small things, right? You would miss whenever you might have studied the ratio. So our focus is to revise all such things. Now in liquidity ratios, you all know two types of liquidity ratios we will be seeing over here, right? They will come later on. They are all short term in nature. Why? I'll tell you. So in liquidity ratio, I want to see that, see, in my business, there are current liabilities. Current liabilities which I need to pay within a year. जिनको मुझे एक साल के अंदर अंदर pay करना है, those are known as my current liabilities. Now, क्या मेरे पास इतना पैसा है कि मैं अपनी current liabilities को pay off कर सकूं? Do I have enough money to pay off my current liabilities? That I know through the current ratio, right? So current liability is the liability which I need to pay within a year, and through liquidity ratio, I want to see that whether I am able to pay off my liabilities or not. Now next thing is the solvency ratio. What is solvency ratio? So it is the business ability to meet its contractual obligations towards the stakeholders, particularly towards external stakeholders. So they are called as the solvency ratio. Basically, they are long term in nature And what we are talking about over here is that whether we have enough funds to pay off my long-term liability. Long-term liabilities are which are payable after an year, right? Which are payable after an year. Now here I would like to introduce to one more concept. See, when we are reading, when we are doing any particular chapter is we are also covering the concepts, so that if any kind of question comes into the examination, we are able to solve it. So do you understand the concept of asset liability mismatch? Wait. Do you understand the concept of asset liability mismatch? So this was the problem with which our banking sector was suffering. See, asset liability mismatch arises when there is difference of maturity in between your funds. Now what I am saying is, understand this. So whenever I am writing the current liabilities are short term in nature. I need to pay them in a short term, right? So what I should do also is that I should have enough current assets for this. Current liabilities should be paid off through current assets, right? This will be a good thing. And your long-term liabilities should be covered by long-term assets. This is the ideal scenario, right? This is the ideal scenario. This should happen, and this will be called as asset liability match, right? Long term nature liability will be funded by the long term assets are funded by long term liabilities, and short term assets are funded by the short term liabilities. Now the problem in banking sector arose because they were funding their long term assets with the short term liabilities, right? So this was a problem. Okay, let's not go to the banking sector, come back over here. So when we are comparing the short term liability with short term assets, we are talking about the liquid ratios, fine. And when we are talking about the long term liabilities with the long term assets, we are talking about your solvency ratios. Okay, and you can also link it with the banking. So in the banks, it has been mandated to maintain a liquidity ratio, and it has also been said to the bank that they have to maintain an NSFR ratio. NSFR is what? Your net stability funding ratio, right? So that depicts this. Now we are done with this particular concept. Solvency, now you have understood. Solvency is long term in nature. Next thing is activity ratios. Activity ratios, it shows the efficiency in your operations. Efficiency of operations and effective utilization of resources. They are also known as the efficiency ratios. So see, this is an important fact over here. Activity or turnover ratios, they are also called as the efficiency ratio. Now what are these ratios? I am hoping that you might have studied it. This is also called as the inventory turnover ratio, debtors turnover ratio, creditors turnover ratio. What you are comparing in inventory turnover ratio? That as compare whatever production you are doing, whatever inventory you are having, are you able to sell it, right? Are those inventories going out of your hand, or you are just piling up the inventories, right? So collecting inventories is never a good idea, because as a business we should always try to sell it. So that is your inventory turnover ratio. Next is debtors turnover ratio. Are you able to collect the debtors, right? Obviously, suppose whenever I am selling the goods on credit, suppose I sold this particular pen to someone. The person said that I will pay you this 1000 rupees after 6 months. So Is it good that I receive the money after 6 months, or is it good that I receive the money just in 1 month? Obviously in 1 month, because I am doing a business. I need to do production, and for that I need money. So all these ratios, if they are high, then it is a good sign. High inventory turnover ratio, high debtors turnover ratio, high your but not that for creditors turnover ratio, because it is a liability sign. So anyways, we'll be discussing them in detail also. They will be discussed one by one. Next thing is profitability ratios. Profitability is the analysis of profit compared to the revenue that we are getting, and hence they are known as the profitability ratios. One few we have already seen, like the gross profit ratio, net profit ratio, etc, etc. We will be talking about each of them one by one, but first let's start with the liquidity ratios. See, in liquidity ratio, the first and foremost important thing is your current ratio. Why do they come under the functional head? See, they come under the functional head because we are dividing them on the basis of, see, if you want to classify them, you can classify as in form of traditional basis as well. But functional basis means what we want to derive from these particular ratios. When I am comparing current ratio, when I am calculating current ratio, I want to know that what is the purpose of this ratio, right? So when you classify any particular ratio on the basis of purpose, that is called as the functional classification. So purpose of this ratio is to find out whether you are liquid enough or not. Okay? Acha, tell me one thing. If I have to classify this current ratio in form of traditional classification, then what type of ratio will it be? If I have to classify the current ratio in the traditional terms, then what kind of ratio it will be? Anyone? It will be a balance sheet ratio, because both the terms current assets as well as current liabilities, they are taken from the balance sheet. Okay? Now let's see. Current ratio is what? Current assets to current liabilities. Current assets divided by current liabilities. This is the ratio. Fine. After that, what are current assets? So current assets includes current investments. Investments which can be redeemed within a year. Next, your inventories, these are also my current assets. Trade receivables, that means the debtors as well as bills receivable. Cash and cash equivalents, short term loans that I might have given, and advances. Other current assets like prepaid expenses, advance tax, accrued income, etc, etc. Now obviously inventory, debtors, ये सब तो आपको पता ही होंगे. You have to focus on these. Accrued income means income which I have earned but I have not received it. Suppose I have taught you this particular class, right? As soon as I have taught you this class, I have earned my remuneration. Fine. So I can show this into my balance sheet. But I have not received it in cash. Okay? I have not received in cash, but still I am eligible to receive it. That is why accrued income is my current asset. An asset which I can redeem within a year. Next is advance tax. See, tax is a liability. Tax is an expense, right? You have to pay it. And if you have paid it in advance, that means in next period, you have to pay less. Fine. So the liability of next period gets reduced because of the payment in advance. So this is also a current asset for me, and similarly prepaid expense. Okay? So please remember these 3 points. These are also your current assets, especially the students which are from non-commerce background. Next is current liabilities. All such liabilities which needs to be paid within a year, they are called as the current liabilities. So your short-term borrowings, your trade payables. Trade payables means, suppose if I am into the manufacturing of biscuits, then the suppliers from whom I am procuring the maida, from whom I am procuring the palm oil, the sugar, etc. All such things which are used into my business. So such people, they will be called as the trade payables, and any other current liabilities and short-term provisions like any kind of outstanding expense, that is also my current liability. Now one more thing, what is the ideal current ratio? So ideal current ratio is 2:1. At least this much should be there. So if I have 1 lakh current 1 lakh rupees worth current liabilities to be paid, then at least I should have 2 lakh rupees worth of current assets. I repeat, if I have to pay 1 lakh rupees of current liabilities, then at least I should have 2 lakh worth of current assets. At least I am saying. So if my current ratio is 3:1, then that is great. 4:1, great. But if my current ratio is 1:1, that is not great. Okay? That is not a great sign. Now next is the quick or liquid ratio. This is also a sign of liquidity, also known as acid test ratio. It has another name called as the acid test. Okay? So it is a ratio of quick assets to current liabilities. Now see, out of the current assets as well, this is your current assets, right? Now in these current assets, a part is also called as liquid assets. A part is also called as the liquid assets. What are these liquid assets? So inventory, I do not know that whether it will be convertible into cash within 90 days or not. Okay, so liquid assets are those assets which are convertible into cash within a period of 90 days, right? So stock is not a liquid asset, number one thing. Prepaid expenses, they are not a liquid asset. So they are removed from the current assets in order to find out the liquid assets. See, quick assets are defined as those assets which are quickly convertible into cash. I told you the period is 90 days. While calculating quick assets, we have to exclude the inventories as well as other current assets like advance taxes and prepaid expenses. They should not be included while calculating the liquid assets, because I know that they cannot be converted into cash within a period of 90 days. So this is called as the quick asset. Liquid ratio, they are calculated as liquid assets divided by current liabilities. It is written, it is the ratio of liquid assets to the current liabilities. Fine. Now what is the ideal quick or liquid ratio? The ideal ratio is 1:1. Again the same thing. This is at least. This is what? This is at least 1:1 should be there. If my current liabilities are 1 lakh rupees, then I should have a liquid assets of at least 1 lakh rupees. Similar amount, right? If I am having a liquid ratio of 0.5:1, then that is not a correct thing. Okay? Done? Now we are done with the liquid ratios. The next thing that we'll be talking about is solvency ratios, also called as the, see, I know you are you know the term insolvency, right? Insolvent means a person who is not able to pay off the debt. Insolvent means if you are not able to pay off your debt, then you are an insolvent, right? So these solvency ratios, they are long term in nature. We have already studied that the solvency ratios are long term. Liquid ratios were short term in nature. So in this particular case, debt equity ratio का मतलब क्या होगा? Debt equity ratio tells you the relationship between long term debt and equity, right? So the ideal ratio is 2:1. Now this is max. Fine. This is the max. So normally it is considered to be safe अगर डेट इक्विटी रेशियो 2:1 है तो. Now why I am saying this? See, debt equity ratio is long term debts divided by shareholders fund. In this particular case, if my shareholders funds are 1 lakh and my long term debt is 3 lakh, ratio is 3:1. Now tell me by yourself, is it a good thing having more of external debt compared to your own funds? It is not good, right? Because you see, you will not be having enough funds to pay back your long term liabilities, right? You will not be able to pay back because your own funds are less and your debts are high. So hence it is said that 2:1 is considered safe. If your own funds are 1 lakh and your long term debts are 2 lakh, that is sufficient. You should keep the debt equity ratio up to that. Obviously it is suggested, right? It has not been a compulsion. So what I mean to say, it has been said in the accounting ratios, but practically companies do have a debt ratio more than that as well. ठीक है, जैसे हमारी government of India, they say that you have to maintain a fiscal deficit lesser than 3%. You should try to fix it at 3% and you should try to bring it down. But what is government right now doing? Because of the needs as well as other things, they are not able to keep the fiscal deficit at a required percentage, right? So this is the same concept over here as well. So I hope you understand this, right? If debt component of total long term fund is small, then the outsiders feel more secure. Now suppose shareholders funds are 1 lakh and right now my long term debts are just 50,000. So you will be more interested to give me loan, right? Because you will see that right now the long term debts are small for this particular organization and its own funds are more. So you feel secure enough, correct? So this was your debt equity ratio. I have explained you from all the possible angles. Now next thing is your debt to capital employed ratio. So in this particular ratio, what you are comparing? You are comparing your long term debts with the capital employed or net assets. Now what is capital employed? So capital employed is long term debt per plus shareholders fund. This means to say, what are the total funds you have? In the debt equity ratio, we just included shareholders fund, right? But here we will be including long term debt also. So what is the total funds we have? Long term debt plus shareholders fund, right? This is the total capital we have employed in my organization and I will compare it with the long term debt. Fine. So like debt equity ratio, it shows that the proportion of long term debt in capital employed, if the ratio is low. Now you should also understand one thing. In ratio analysis, it is very important to know that if I am talking about this particular ratio, whether it will be good of having a high ratio or low ratio. So if I tell you that debt to capital employed ratio is high, so what is the meaning of it? ठीक है, what is the meaning of it? What is the implication of it? This thing also you need to understand in order to cover the ratios comprehensively. ठीक है, so low ratio provides the security to lenders. So lenders think that no problem, if we are giving the loan to this particular company, this company will be able to give back our loans, right? And high ratio helps the management in trading on equity. So if my organization is there, what I will want? I will want that my capital should be less and I should borrow the money from outsiders and do business onto it, right? This is called as trading on equity. Trading on equity means when you keep your own equity less and you borrow from outsiders to do the trade. ठीक है? So for management, a high ratio will be good, but if you think from the perspective of outsiders, that means the people who are giving you a loan, they want a low ratio. ठीक है? They will not give a loan to such an enterprise which is already indebted. indebted. If you are already into too much loan, then nobody would like to give you the funds. So this is your long-term debts to capital employed ratio. Now, next thing is proprietary ratio. Proprietary ratio means, so it expresses the relationship between the proprietor's funds to net assets. See, proprietary ratio is your shareholders' funds divided by capital employed or the net assets. It means to say, see, for this particular ratio, only knowing the formula is enough. They want to know that जितना भी capital आपने employ किया है, whatever is the total capital employed by you, that means the long term plus shareholders funds, out of that what is of your own. So essentially what we are doing, shareholders fund divided by long term funds plus shareholders funds, that is what our capital employed is. So here we want to know that out of the total funds how much you have invested of your own. This is called as your proprietary ratio. Next is long term assets to debt ratio. In this particular ratio we want to see that how much of the assets they have been made by using the long term debts. मतलब कि अगर ऐसी total assets must have been made with your own funds plus borrowed funds, right? You would have got the money to make the assets only out of these particular two factors. Either you have purchased the assets out of your own funds or borrowed funds. So we want to know that how much percentage of your asset is financed by long-term debts. That is called as the total assets to debt ratio. So the higher ratio indicates that assets have been mainly financed by the owner funds and the long-term loan is adequately covered by the assets. Higher ratio means, suppose if my total assets are 10 lakh and my long-term debts is 1 lakh. So my ratio is 10, and suppose my assets are 10 lakhs and my long-term debts are 5 lakhs. So my ratio is 2. Now compare these two. Here the ratio is high. That means I have financed my assets out of my own funds. You see, my long-term debts are just 1 lakh rupees. That means I have financed the assets out of my own funds. Higher ratio indicates that. And if the ratio is low, that means I have taken substantial finance from the outsiders as well, from the debts as well. ठीक है? So this is the comprehension. So in the ratios you have to understand the description, why such ratio is being calculated, what will be the implication if ratio will be high, what will be the implication if ratio will be less. So these were the two types that I wanted to cover, liquidity and solvency. Tomorrow we will be covering the activity as well as the profitability. ठीक है? Like I always say, if you do have any kind of questions, you can drop in the comment section, right? Or you can also ask me tomorrow, correct? When we'll be talking about ratios. And if you did like this video, then please do not forget to hit the like button. Thank you so much.